Welcome to the special live stream session. Amanda, I'm super fired up to talk about the Federal Reserve's decision today to keep the interest rate steady at 5.25 to 5.5%, or maybe they'll surprise us with a rate cut today in about 30 minutes at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Standard Time. And as always, I have my favorite channel, Bloomberg, ready to go. And this is also being live streamed in my private group. So if you're interested in joining my private FIRE community, you can get a free trial by visiting firestatechat.com/community. Jerome Powell is also going to have a press conference at 11:30 a.m. or 2:30 p.m. Eastern Standard Time. And so even if the Fed doesn't cut interest rates today, I want to hear what he has to say, because he should give us a better idea of what his thoughts are moving forward in September. And if you're watching this on replay, I'll be sure to leave chapters in this video so that you can navigate your way around the live stream. And hello to Kevin Hawthorne. All right, cool. And let me show you this. And before the interest rate decision comes out, this just came out yesterday from the Bureau of Labor Statistics. So let me make sure I got, oh, I don't have that right. Okay, there we go. Let's scroll that out. All right, so only 8.18 million jobs were open at the end of June, which was a decrease from 8.23 million jobs, job openings in May. And the JOLTS, if you don't know what that is, that's the Job Openings and Labor Turnover Survey. And it showed 5.3 million hires were made during the month of June, which was a decrease from 5.7 million in the month of May. The hiring rate declined to 3.4% from 3.6% in May. And this is where the Fed needs to be extremely careful. Inflation is one thing, but rising unemployment is a completely separate issue that could take a long time to recover from, right? And we're going to get the latest unemployment data on Friday to get a better picture of our overall labor market. And people are no longer quitting their jobs like they did in 2022 and 2023, which means that they're feeling a little bit less secure about finding another job if they leave their current one, right? The expectation on Friday's jobs report is that unemployment holding steady at 4.1% and 175,000 jobs. And I think the Fed needs to start cutting interest rates today to make sure we don't go through a recession. That's going to be much more difficult to recover from. But the CME group is predicting that there will be no rate cuts today. And the reason is that the Fed, and I'm sure they're going to say it, is they're going to need more data before they start cutting rates in a few months. Maybe the Fed will surprise us with a rate cut today based on the data we've seen so far. And as much as I want them to cut interest rates today, I don't think they're going to, because Jerome Powell and the rest of the Fed are looking for more data from now until the next Federal Reserve meeting on September 18th. And I'm going to be on live stream for every Fed meeting and every CPI release. So be sure to subscribe if you haven't done that already. So the market is already pricing in that there's going to be a 100% chance the Fed will cut interest rates in September. Could this change between now and September 18th? Absolutely. But our economy is already showing some cracks and several signs of weaknesses. And I'm going to go over that before the Fed's decision in about 25 minutes. It would be interesting if they actually cut rates by 50 basis points, which there's like about a 10.2% chance on September 18th. And that's not necessarily a good thing, because they may be trying to avoid a recession. And doing this could help avoid it, but at the same time, it may be a little bit too late. And we all know how the Fed has been reacting since 2021, right? And September's meeting will also give us the summary of economic projections, or SEP, which will give us a better clue about how many times they're going to cut interest rates for the rest of 2024 and the year 2025, and what their GDP projections are, and where they think the unemployment rate will be for the rest of the year and in 2025. And if you're especially looking to borrow money in 2025 because you're buying a house, starting a business, or expanding your business, I strongly encourage you to mark your calendar, or make sure to get your notifications by subscribing to this channel or joining my community at firestatechat.com/community. The Fed meeting in September could possibly be one of the last ones for Jerome Powell if Donald Trump gets elected in November. And Trump already said that he's going to replace Powell and if he gets elected in November. And the Federal Reserve meeting in November is 2 days after the election day. So it's going to be very interesting to watch. We're also going to have another meeting on December 18th. You know what? Let me scroll. That was in 2023. Sorry. So there's going to be another meeting on December 18th, which will also come with another version of the SCP. And I put this schedule together so we know what to look for between now and September's potential rate cuts. Last week, the advanced estimate for the Q2 GDP came out on July 25th with a surprising rate of 2.8%. But what I want to pay attention to is the second estimate on August 29th and the third estimate when it comes out on September 26th. But that's going to be after the September FOMC meeting. The PC inflation also came out last week on July 26th. The U.S. Consumer Confidence Index, or CCI, also came out yesterday, which is still going down. And so I'm going to go over those in a little bit. The unemployment data or employment situation will be released on August 2nd and September 6th. Those two labor reports will be crucial for the Fed's decision in September, because keep in mind, they can always say, you know what, we're going to keep the rate steady the way it is in September, and they could delay the rate cuts until November or maybe possibly December, or maybe no rate cuts at all this year. And the next CCI, or the Consumer Confidence Index, will come out on August 27th, and that will be the only one between now and the September Federal Reserve meeting. The PCE inflation will also come out one more time on August 30th, and the Consumer Price Index, or CPI, will come out two more times on August 14th and September 11th, and I will be going live on those events as well. And this is the SCP from the June FOMC meeting, and this is what I want to pay attention to. The Fed changed the rates from twice in 2024 to just cutting interest rates once for the rest of the year in 2024. And if I had to guess, they're probably going to change this to twice or maybe even three times for the remainder of 2024 if the economic data comes in much weaker than expected. And the Q1 GDP came in at 1.4%, and the Q2 GDP, or the first advanced estimate, came in much higher at 2.8%, or double the GDP rate from the previous quarter. And what this tells us is that consumer spending is still growing at a higher pace, and this is what the Fed is worried about. If they cut rates, is our inflation going to flare back up again? While our consumer spending is up, the personal savings rate continues to drop from 3.8% to 3.5%. So that was 3.8% in Q1 to 3.5% in Q2. And that's alarming because people are still spending more than they're saving. So if people say GDP is really good, I think we need to kind of look at it in a different way and just say, well, take a look at what consumers are still dealing with. The inflation we're looking at from this year to the previous year, right? But what about all the inflation rates that have gone up from 2020, I would say 2021 to 2023, right? So those are all just constantly accumulating, in my opinion. But anyway, let's take a look at this. So if you look at the GDP result from this chart, some people will say we're in a good economy, sure. But if you look a little deeper, the rise of consumer spending was one of the contributing factors. So people are still spending a lot more money because the prices are high in many of the areas. Groceries are still high. Gas is okay. Car insurance is high, and homeowners insurance is still high. And the other thing is the government spending also rose by 3.9% just at the federal level. And that's including a 5.2% surge in defense outlays. And this GDP report shows that imports jumped 6.9%, which is the biggest rise since Q1 2022, while exports only went up by 2%. Not to mention, home prices are still going up. Even with the decline in demand, some of you in the comment section are arguing with me, I don't know why, that your interest rates back in the 70s were 12 or 15%. But let's face it, the level of income has not caught up while home prices continue to increase. The median sale price in the US in June 2024 was $442,000. So assuming that you get a loan out for $440,000 with a 6.9% 30-year fixed interest rate, you're going to be paying almost $3,000 a month just in P&I. Just in P&I. That's not even counting your escrow payments for your taxes or your homeowner's insurance, right? So if you use the 25% rule, you would need to make at least $144,000 a year to get that the average home price of $450,000. Do you know how many Americans make $150,000 a year? That's about 20%. And when you live in a place where the cost of living is much higher, that $150,000 a year is not going to be much more. Well, it's not going to be much at all for a family of four. And I know some of you would disagree with me on this in the comment section. I welcome them, but home affordability today is just not the same as how it was in the 1970s or 80s. You can't really compare what's going on today with the interest rates to the 1970s and 80s. And I get that inflation was really high from the Jimmy Carter era, but what we're dealing with today, you can't really compare that with what happened 40 years ago. And the housing market, let's take a look at this. Speaking of housing market, the housing market will continue to be an issue because people who got a 2% or 3% mortgage rates will most likely stay where they are unless they have to move or they have to cash to purchase their next home. And if you look at the US housing market, the overall median sale price was $442,000 in June 2024. And if you look at January 2024, let me scroll down here, make sure. This January. There you go. So if you look at January 2024, it was about $402,000. And the problem is inventory, right? Like I said, people with 2% or 3% mortgage rates will most likely not sell their homes because why would you sell your home now just to get another mortgage for 6 to 7%? And unless you have the cash to pay for the next home, or maybe you have a sizable equity in your current home and just apply it to the next home. And if I sort this, let's see, by single family home here, it's so much higher. The median sale price is much higher at $464,520. And this is with what is it? Hold on. Yeah, this was like with a 11.2% decline in homes sold year over year and a national average of 30-year fixed mortgage at 6.9%. So more Americans are delaying their first time home purchases because now they need to save more for the down payment. If the home prices rise to $500,000 by next year, even with the 3%, to say first time home purchases, 3% minimum down payment would cost you $15,000. And if you're a low income earner, getting to $15,000 is very, very difficult. And if you're looking to make a 20% down payment, that's going to cost you $100,000, right? And how many years is it going to take you to buy a second home with a 20% down payment? Now, there are three scenarios. The mortgage interest rates could drop in August. And I'm saying August, not September, August, which is tomorrow. One, if the Fed cut the rates unexpectedly today, which is about a 5% chance or less than that, that's happening, then I would expect the mortgage rates to start dropping rates as early as tomorrow. And we'll see what happens. And two, I want you to pay attention to the inflation rates. When we get the consumer price index or CPI report, every time I go live stream, you're going to see the 10-year treasury note just going up and down, right? But the next one on August 14th, if we see a drop in inflation, rates on borrowing products could also start to fall because of that. And this is why I go live every single time CPI comes out. And I wouldn't be surprised if the mortgage rates drop further starting on August 15th. And three, lenders could preemptively start cutting mortgage rates if they're seeing economic signs of easing inflation. So the bottom line is that we could see the mortgage rates drop significantly more going into August and September if they cut rates in the September Fed meeting. But don't be surprised if these home prices continue to rise when they cut the rates because the demand to buy homes will also surge, right? And if you take a look at your high yield savings account, you probably got a notice very recently that they're going to start cutting rates on their end. So I bank with Ally Bank, and this channel is not sponsored by Ally. Ally has been a great bank for me. I've been banking with them for the last 8-9 years. And they, I think they sent out a notice about 2 months ago that they're cutting rates from, I think it was like 4.5% down to 4.35%. Right now, I believe it's like probably around 4.3%. And you're probably going to start getting those notices too. And if you're trying to lock in, let's say you're trying to save for a home right now, one of the best ways is probably to invest, not invest, but save in a CD, because the CD is going to lock in the rate right now. And let's say you get a 6-month CD rate, right? And you put 10 grand in there, and you get a let's say 5%. That's 5% divided by 2. That's what you're going to earn for the next 6 months. But if you get a 1-year CD and lock in for 5.25%, that's 5.25% you're going to get. In a high yield savings account, they can always adjust the rates based on what's going on in the economy, right? Like what we just talked about. So that's something that you want to keep an eye on. Now, not only will the Fed need to lower interest rates, this is my personal opinion, but we just need to build more homes. All right. It's easier said than done. I get that, because those builders will take out more debt to build single family homes. But when interest rates are high, like right now, these builders are limiting how many homes they're building, or otherwise they're going to go bankrupt. And what if the demand drops? Those are the things that they have to kind of balance. And there are some counties and states, and I know a lot about California, they don't give out permits for many years, and that's frustrating for many builders. And check out the this latest PCE inflation from June. And PCE stands for personal consumption expenditures, and the price index only increased by 0.1% in the month of June and was up 2.5% from a year ago. So we're still seeing the steady decline in PCE inflation, and that data also shows up on the SEP that the Fed releases every quarter. And core inflation, which excludes food and energy, showed a monthly increase of 0.2% and 2.6% from a year ago. And both of them are also in line with expectations. This is an important gauge for the Fed to show that inflation has eased from a year ago. And don't get me wrong, some items we pay for are still dang expensive, like our groceries, car insurance, and homeowners insurance, right? And the PCE inflation may be showing that it's cooled down, but it's only from a year ago, and not how inflation has increased from 2020 to 2024. Like car insurance, for example, the premium went up by 26% year over year. Why do you think so many Americans are ditching their car insurance? And it's not safe to do that, but it's also because a lot of people just can't afford it anymore. So it has been a good couple of weeks for the Federal Reserve, but it's been some terrible years for the country. And I wouldn't be surprised if the Fed decides to cut rates today and just say, well, this is good enough for us, so let's start cutting rates. Or this is more realistic, they could start talking about how they're going to start cutting rates in September at the press conference at 11:30 a.m. or 2:30 p.m. Eastern Standard Time. And it'll be interesting to see, because we're less than 100 days out from Election Day, right? And a lot of people are ready for the rate cuts to start so that they can buy their first home. But there are other half of people who believe the rates should remain high so that inflation doesn't flare up. So it's a very, very sticky situation, right? I still believe that we should cut rates. Let me answer this question real quick. And this is being live streamed to several platforms, including my private community, Instagram and Facebook. And so if you want to follow me there, feel free. You get a lot more behind the scene, I guess, on my Instagram stories. But yeah, I just want to say hi to everybody real quick. Hey, Chip from Jacksonville. I am going there next year. Jacksonville, I love it. Love the area. And in Tampa, Florida, went there probably 5 years ago. I need to go back there and see what's going on there. Cali, where are you from? We're in California. New Jersey. Wow. Yeah. And gonna be on the East Coast next month. Just tour around the area. I'm trying to figure out where I should go on the East Coast. Let me know. All right, cool, nice, awesome. And yeah, 4.2%. Ally, nice, 12 years. Yeah, when I first started my Ally in 2016, my APY was 1% because the interest rates were like near zero, right? And my Ally high yield savings account was like 1%. And at one point, I think it went down to like 0.9%. I'm like, but it was still better than 0.8%. A lot of people don't realize that how good we have it right now. And I know I sound like an old man when I say that, but having that 4%, 5%, this is the best time for you to take advantage of it. So if you're in debt, get out of debt as soon as you can, right? But if you don't have any debt, high interest economy is the best time for you to save cash because you can't, you could earn 4.5, 5.5%. Last year at one point it was like 6% for CDs, and those were really good too. But um, hey, Nancy, Alamogordo. Yeah, yeah, Betterment 5.5%. I'm guessing that's a CD for 90 days, right? So is that a lock in? Let me know how that goes. Okay, so I'm gonna be live streaming on that. And there is a question that just came in. I want to answer this real quick. So should I pay extra on my 30-year fixed mortgage? And you have a 3% and you're at 42 and you want to retire by 58 years old. Okay, so I know we just talked about the HYSA, right? So the metric that I typically use is how much can I earn from the high yield savings account? I know that's such a generic answer, but I'm going to try to break it down for you. So your mortgage rate at 3%, that's going to give you more opportunity in the stock market. So if you're looking to just pay off your home because you're much more risk averse, then feel free. I mean, there's no right or wrong answer on this, but there's also, you just have to realize that there's also going to be a opportunity cost that you could miss out on. So if you're, you got a 3% mortgage rate for the 30 years and your home equity keeps going up, and what's going to happen with the stock market, right? I mean, you could get an 8% return for the next 10, 20 years on average annual return. And it may be even better because like the S&P 500 has been performing like 12% average annual return for the last 10 years. So when I look at, I just use the HYSA metric with, let's say 5% APY, and the mortgage is at 3%, right? So with the mortgage, say the balance, I don't know what your mortgage balance is, but if it's like $300,000, and if I put that into a 5% APY, the 2% difference is going to be pretty significant. So that's something that you want to keep an eye on. So if I were in your shoes, let's say I'm going to use 400K mortgage balance, and I would deposit that into the 5% APY instead of paying that off. And I'm guessing that's your question, is that you have the money to pay it off now. But I would, just putting money into the savings account is going to be paying more than the 3% mortgage rate. But if you want to retire and you are considering your risk and your age, and you are 44 years old, and if you're going to be, let's say 50, right, and you want to retire at 50, you don't want any debt on it, then have a plan to pay it off within the next 6 years, 7 years. Or you don't have to pay it all at once if you don't want to. You can just kind of like pay it off in segments for the next 10 years, 15 years, or something like that. So if you have a 30-year fixed mortgage, you can always plan to pay extra once a year or every month. And so that you turn that 30-year fixed mortgage into a 15-year payoff plan. Okay. So consider your age and consider your risk. And so the other question I had the other day, someone asked me, one of my clients was, if I want to buy a house right now, it's going to hurt. I feel like, I'm paying a lot. 7%, let's say 7% APY. And, what is it? You're paying like a $400,000 home. And the P&I is going to be about 3K per month between the principal and interest. And if you're looking at escrow for, let's say, homeowners insurance plus property tax, I mean, that could easily be between $3,700 to $4,000 a month, right? So if I were to buy a house right now, I would make sure to have enough cash set aside so that you don't exceed 25% of your gross income towards your home payment. You don't want to be house poor. You don't want to pay 30% of your income towards your home, your mortgage payment and everything else, because now you don't have any room to pay for your fund or invest in retirement or investing something else in short term. A lot of people made their mistakes in 2020 and 2021 to the point where they were paying 45%, 50% of their income towards the mortgage payment. And that's a problem because now they got to pay another, they got to make these expenses, they got to make these payments. And some of them never even sold their homes and they just bought them. And you want to make sure that if you're going to buy $400,000 with 7% mortgage rate, and if $4,000 and let's say $3,000 divided by 25%, that would be $144,000 a year, right? So let me do the calculation real quick, just the worst case scenario. So if your mortgage payment is $4,000 a month divided by 25%, I mean, you got to make $160,000 a year in gross income. And that's what I was talking about earlier in this live stream, is that how many people make $160,000 a year? So home affordability obviously is going to be an issue. Do I think the home prices are going to come down? In some areas they will, but I live in Vegas, and the demand in Vegas is ridiculous because Californians and other people from other states, and I'm not targeting Californians here, they're coming here and they sell their homes in California with the large equity, and they come here and buy a house with cash, right? And it's just not just California, but maybe New York and other states come here and just buy a house with cash. So people are still buying homes regardless of the mortgage rate. But the other problem is there's not enough inventory. So just to answer your question, though, it's up to you. There's no right or wrong answer on when you want to pay it off, but you do have a low mortgage rate. And if I were in your shoes, I would keep investing while the mortgage rate is still low. But if you feel like you're risk averse, you want to pay off all of your debt and retire early and not have to worry about any payments, go for it, since you got the cash. But really good question. Good luck to you on that. Okay, so let me take a look. What? Thank you for a super sticker from Sheena Yach. I hope I said that correctly. I really appreciate it. You guys really don't have to send any super stickers or anything like that. This is, I do this because I love doing it. And, it's just one of those things that I'm like, well, love doing it. I care about what's going on in the economy, and this is an election year, and I want to hear what politicians have to say about it, right? So I really appreciate that, though. Thank you so much. Never thought I think I got a super sticker a while ago too, and I didn't think that was a real thing, but it is. Yeah. Ooh, don't forget that. All right, Birmingham, Alabama, Henry. Good to have you here. All right, let's take a look and let's listen to the
reinvestment risk when the cycle turns. So yes, we have seen a fair number of clients, heed that warning, and particularly using not just treasuries and not just municipal bonds, although the valuations there, if you're in a high tax bracket, can be pretty compelling on an after-tax basis, but also in investment-grade corporate bonds and other types of higher credit quality bonds where the yield curve's not inverted and you can actually hold on to some of these yields for 5 to 7 years.
Kathy,
Mo, I got your question, but I'll get back to you on that, okay?
Alongside Bob Michael of JP Morgan Asset Management. Bob's going to stick with us through this decision. On the other side, we'll hear from the former Fed Vice Chair, Richard Clarida. He'll be with us around this table in the studio. 60 seconds away. The scores going into it look like this. Let's start with equities, and then we'll turn to bonds. Equities are positive by 1.5% on the S&P. There's a strong rally in the Nasdaq.
Last time the Federal Reserve website literally crashed.
Before today,
we'll see what happens.
Through the close of yesterday, we were poised for the biggest monthly loss of the year so far on the Nasdaq and the biggest monthly gain
of
gains
in the market
so far on the Russell. The Russell 2000 up by another 8 or 9 tenths of 1%. Switch on the board and get to the bond market. The 2-year, we talked about it. The 2-year has rallied, Lisa, at every single Fed meeting over the last 6. On Fed decision day, is it going to be different this time?
Matt Lazzetti, I'm going to put this in his mouth rather than mine, was talking about how this could be just because we've already baked in more than a full rate cut in September and more than 2 full rate cuts by the end of this year. How much more can they deliver? That said, he has shown a willingness to really give a sense to what kind of weakness we see.
With your Fed decision, here's Michael Key.
There is no change to interest rate. There are a number of small changes to the statement, but this is not a see you in September announcement. The Fed's forward guidance remains unchanged. Quote, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. There's also no change in the overall assessment that economic activity has continued to expand at a solid pace. all of the adjustments are basically to adjectives. Job gains have moderated, the statement says, instead of remained strong. Unemployment has moved up, but remains low. Inflation has eased over the past year, but remains somewhat elevated. And in recent months, there has been some further progress toward the 2% inflation goal. If there is a hint about the future, it's this. Instead of saying risks to employment and inflation have moved into better balance, the statement now says the committee is attentive to the risks on both sides of its dual mandate. The decision was unanimous, and that's basically it. If there is going to be a hint about a September move, it's going to be up to Chairman Powell.
It's a two-part story, Mike McKee. This was the first part. The second part starts in about 29 minutes with that news conference in Chairman Powell. Let's get to the equity market. We stay positive on the S&P 500, up by about 1.5%. On the Nasdaq 100, up by 2.5%.
Market's
in the bond
huge,
market,
man.
yields look a little something like this. We're down about 2 basis points on a 10-year. The move at the front end of the curve. It's a small one, but notable. Up by about 2 basis points on a 2-year.
Okay, so you see that 10-year Treasury note. So that's what you want to follow if you're looking to buy a house in the future, because that's the mortgage rates typically follow what the U.S. 10-year Treasury note does. Okay, so I do want to quickly show you guys what the what he was just talking about more in the extensive way. So they did not change interest rates. They're going to keep it steady at 5.25 to 5.5%. I did advocate for the rate cuts at the beginning of this video, but the chances of that happening was less than 2%. But so take a look at the September 18th, right? So talked about this at the beginning of this live stream, but now there's a 89.6% chance that they're going to cut rates by 25 basis points. And I'm sorry, I should rephrase. They're pricing in 100% chance that they're going to cut the rates in September. You see that there's no 525 to 550 on there, right? So that's gone. That's how you can look at it. So if you look at July, you see 525, 550 is on there, and they made that decision today, and it's already done. If you look at September, they're looking at 89.6% chance they're going to cut rates by 25 basis points, and there's a 10% chance they're going to cut it by 50 basis points. Now, the S&P does say that they're going to keep it at 5.25. I'm sorry, keep the cut the rates by one time. But that report's going to come out in September. So that September 18th, mark it on your calendar. That's going to be huge because we're going to get the latest S&P that day. At the same time, they're going to announce the interest rate decision to either cut it by 25 basis points or 50 basis points. Now, November 1 here. So they're pricing in just rate cut of 75 basis points by 60%. So that's really interesting too, because now they're saying that November rate cut is very likely to go down to 4.75 to 5%. And right now we're at 5.25 to 5.5%. So that's going to be a 50%. There's a 60% chance that we're going to see a 50-point rate cut by 50 basis point rate cut by November 7th. And that is 2 days after Election Day. So I don't know how the election process is going to be. I don't know how long it's going to take for them to announce who has the most electoral votes. If you follow any news channels, and they should announce they usually say AP decision. They're going to call whoever gets elected, right? So we'll see what happens. And then 2 days after that will be the Federal Reserve meeting. And they could very well be cutting rates even further, or they just keep it steady at 5.25 because they want to see more data. And then for the next one will be December 18th, which is going to be the last one of the year. And we're also going to get the latest SCP for December. And that's going to be a critical one too, because the 2025, what we want to see is how that 2025 is going to be. And December 18th is going to tell us what the Fed is kind of thinking, right? So they could be very well be cutting rates down to 3.5 to 3.75%. And I showed you guys the SCP earlier here. And if you take a look at 2025 range, this is a wide range at 2.9 to 5.4%. It's wide because they don't know. They do it on purpose because they don't know how it's going to be. They don't want to put a specific number in there because if they knew what's going to happen, they're going to shrink the range a lot, like let's say 2.9 to 3.5 or something like that. Because if you look at this in 2024, it says 4.9 to 5.4. That's much more specific than 2.9 to 5.4, right? So for the December SEP, this is going to be this one right here is going to be much more specific than what we're seeing now. And we could kind of calculate how many times they're going to cut rates. And in every quarter, things could change, and this is all going to depend on here with the unemployment rate, PC inflation, and then core PC inflation, and as well as the GDP. If we see a recession, let's say 2025 we have negative GDP back-to-back quarter, then they could accelerate the rate cuts to print more money and make it easy money, basically. So I think whoever gets elected, this is my personal opinion, whoever gets elected in November, that person is going to have a very easy job to begin with, economic wise. Stock market, GDP, that's all. It's already on the rise right now. This 2024, 23, 22 is going to be a thing in the past. And people are going to be moving forward in 2025, and that's what they're going to talk about. But remember this, and nobody's talking about this right now. 2025, in January, the debt ceiling is supposed to expire. So that's going to be in the books. They're going to be debating that. And then throughout the year, the Tax Cuts and Jobs Act, our federal income tax, that's going to expire on December 31st. So put that in the book too. Just keep that in mind. Whoever gets elected, they're going to be talking about the debt ceiling expiring in January 2025, as well as the tax cuts that's going to expire by the end of 2025. So we're going to see who, instead of just looking at who's going to be elected as president, pay attention to who is going to be controlling the House and who's going to be controlling the Senate, because that's going to be, if it's a completely Republican controlled House, House, Senate, and the White House, things are going to be pretty easy for them to move forward, passing bills here and there. If it's a divided Congress and then we have a Democrat or a Republican White House, then things could move a lot slower. And, they have been moving very slowly in the past 4 years, maybe 8 years. I don't know. But just keep those in mind. They're not talking about that right now because it is that's not their focus. They're focusing on election and they're focusing on interest rates. So really just kind of like interesting on their decision. I am going to be live streaming for Jerome Powell's press conference just for a little bit. I don't think I'm going to stick around for the whole press conference, and I'll make sure to let you guys know where to go to watch the rest of it. But let me go ahead and go back to the question here real quick. Okay. Let's see. All right. You're investing in Tesla, PLTR. Is that Palantir? Yeah, it's Palantir. QQQM, VOO. Thinking of adding the ETFs, SMH, but I'm not sure. I'm not sure either. I don't know. Do you like it? I mean, the biggest question is, right? Like, do you know what you're doing? You certainly don't want to ask the crowd or ask me because, one, I don't know anything about you really. But when it comes to it, anytime people ask me about ETFs, index funds, and stuff like that, I just ask them, like, are you not happy with your current portfolio? Right? Are you trying to add more risk? Are you trying to de-risk your portfolio? And I don't know anything about that ETF, right? So that's something that I would ask you, like, is it something that you're trying to add more risk so that you have a higher return potential, right? But I'm not targeting you, Mo, but I would say, first thing I would evaluate is, what is your savings rate? Savings rate always trumps your stock market return. So when you look at your entire portfolio and you have, I don't know, say 95% stocks, 5% bonds, is each of them, all the stocks that you just mentioned, are they all performing to the point where you think is meeting your long-term goal, or maybe your short-term goal? Maybe you're trying to buy another asset with the current asset that you have. You know, some people bring up to me and say, I have 1 share of Tesla and it's got 1,000% return. Well, congratulations. You got 1 share of Tesla with 1,000% return. That's it. Why couldn't you buy 100 shares, right? The people are so fixated on the stock market return, what the fund performs, and they forget about, well, what if I could put more money into this, put more money into that, and align those to your goals and make sure that you are meeting those investments are working in your favor. Because I have been truly investing for many years, and some of those investments are working in my favor because I can just leave them in there and I know they will continue to grow every single year, every month. And sometimes we're going to have a bad year. The S&P 500 was down 2022. And you know what? The market was down last week. And when I was live streaming, people were freaking out about the market. And they were like, well, should I sell? I mean, why are you selling when you are literally trying to, buy more, right? People completely forget about the buy low, sell high concept when the market really goes through that correction. I mean, this is one of my price trackers that I have for my clients is, the S&P 500 at one point, it was up by 18%, almost 19% 2 weeks ago. And it had a big correction. Well, I wouldn't call it a correction because it's not 10%, but when it went back down to 14%, 13%, people are like, this is it. Everything is going to crash and I'm going to sell. And people are trying to trade inside of 401k and TSP or IRA. I'm like, those are not the accounts that you want to play, prices on the daily basis. Those are the ones that you want to hold for the long term, buy and keep buying, buy and grow and keep buying. Oh, when it's down, buy more if you can, right? 401k, it's going to be a little different if you're already maxing out. But if you're dollar cost averaging your let's say your Roth IRA, you can always go into your account and buy more shares when the market is down 1% to 2%, because that's the index fund or whatever investment product that you believe will give you a long-term growth. And the other thing you want to keep in mind is that you mentioned 2 individual stocks. So, how much of your portfolio is holding in individual stocks, right? I started investing in Tesla, I would say in 2018 when Elon Musk was tweeting, right? When he was tweeting like funding secured on blah, blah, blah to the SEC, and he got in trouble for that. And Wall Street was like, he's going to go bankrupt. Tesla's not going to go anywhere. And, I think I ended up rebalancing my portfolio because Tesla's, the holding just became too big. So something else to just kind of consider. I don't know. I guess that would be the answer is, I don't know. I am not sure either, but do more research and find out what that ETF offers, what it holds, how many stocks and bonds, or maybe it's all stocks, right? So let me know. Why really? Pharaoh said starter home prices are over 1 million, $1 million in 200 cities. Let me guess. Are they in California, New York, New Jersey? Jeez, that's insane. 200 cities starting at $1 million. I saw some memes. It's like, you could buy a 800 square foot home in California, like in a little shack for 1.2 million. Man, that's insane. Cool. I mean, if you like treasury bills, go for it. But then, just remember the opportunity cost, the opportunity of gaining more in the market. And the other thing that people don't forget about this is that anytime you buy treasury, the interest that is paid out to you, and I'm guessing that's in a taxable brokerage account or like some kind of a self-managed investment account, right? Not in a retirement. Okay. I don't know, but if it's in a retirement account, you're not going to pay any taxes on that. But if it's in a taxable investment account, you're going to owe federal income tax on it. So if you're making $1,600, $1,800 a month on treasury bills, that's great. Just remember to add that to your regular income right now. So if your marginal tax rate is at 22%, you got to take out 22% of that treasury bill that you buy. And you know, if you want to go with the 1 year, I mean, you just got to know if it's right for you, and then if it's going to be, you know, how much of that the tax is going to be taken out. So that's something that a lot of people just kind of don't think about, is when they sell their investments. You need to track your capital gains tax throughout the year. You need to keep track of your qualified dividends, ordinary dividends that you get from your investments, because not all of your dividends that you get paid is in long-term capital gains, right? So some dividends, ordinary dividends like REITs, that would be all taxed in the ordinary income tax. So that's something you want to keep an eye on. All right. So I think that would be cool. All right. Let's see. Okay. Yeah. You know what? Yeah, I'd be happy to give you more breakdown on the dividends real quick. Let me make sure the time is still good. All right. So we have. Hold on. Okay. Yeah. Are they? So let me go through the question. So can you explain a little more about dividends? Are they taxed like capital gains? So as I was just saying, not all dividends are created equal. All right. So when it comes to knowing your what type of dividends that you're getting, you need to log into your account and take a look at what investments you have. Right. So if you're let's say, so there's the qualified dividends. Okay. And let me see if I can make another box. And then there's another one that's called non-qualified dividends. Sometimes it's called an ordinary dividends. Okay. A qualified dividends, so that needs to be paid by a U.S. corporation or a qualified foreign corporation. Okay. So let me see if I can write that. So U.S. or a qualified foreign corporation. A qualified foreign company just needs to meet one of the three conditions. So the foreign company was incorporated in a U.S. possession. The corporation is a part of the income tax treaty with the U.S., or the foreign stock is traded on the U.S. stock exchange. In most cases, they are. So, you know, if you take a look at Novo Nordisk, that's a pharmaceutical company from Denmark that is traded on the New York Stock Exchange. So when that company from Denmark pays you dividends to say you're the shareholder and they pay you dividends, it is considered a qualified dividend because of that reason, because it is being traded on a New York Stock Exchange. And whenever you invest in a foreign stock on the New York Stock Exchange, then the dividends could be categorized as qualified dividends. Okay. But make sure you confirm that before you invest. And the other one would be Alibaba. I don't think they pay dividends, but if they did, but because they're listed on the New York Stock Exchange, that's not a company that you could have qualified dividends coming in either every quarter, semi-annually, or annually. Okay. And you also have to hold a stock for a certain period of time. For common stocks, which is what most of you invest, require you to hold at least 60 days out of the 121-day period, beginning 60 days before the ex-dividend date. Okay, so if you meet these requirements, then you're gonna be taxed at 0, 15, or 20% long-term capital gains tax rates. And here's what's considered a non-qualified dividends. So besides not meeting the requirements to be a qualified dividend, you have to understand that not all U.S. companies are corporations, right? So I talked about real estate investment trusts, so REITs, and master limited partnerships are not structured as corporations for tax purposes. So the IRS, I'm going to write that down. I'm going to use REITs as an example, and MLPs. So the IRS considers REITs as pass-through income because at least 90% of their profit a REIT makes is given out to the shareholders as dividends. So that's how the tax is structured in that in the REIT, in real estate. So REITs are probably one of the most popular investment options in people's portfolios. But if I were to invest in REITs, I would invest it in like a 401k, Roth IRA, or some kind of tax deferred account so that I wouldn't have to pay federal income tax every year for the ordinary income tax, right? And every dollar under non-qualified dividends, it's going to be taxed under the, what is it at 10, 12, 22, 24, 32, 35, and 37%. So if you're a high income earner, you need to especially pay attention to how much you get paid in dividends every year. And it doesn't matter if you're reinvesting your dividends right back into the stock in your taxable brokerage account, you still have to pay dividend taxes every year if your stock or stocks are not in a tax deferred investment account. And if your entire taxable portfolio, let's say, is in REITs, and then that could hurt you during the tax season with all of the dividend payments if you don't carefully plan for it. So if you have, let's say, 100K in dividends coming in, but that's all going to be taxed under non-qualified dividends, and you're already making, let's say, $200,000 a year, and as a married couple in a 24% tax bracket, this is potentially putting you at 24%. So $24,000 of that is going to the IRS. So you want to plan very carefully. If I were to invest something like REITs to diversify my portfolio, more exposure to the stock market, then I would probably, put that into something that's more like tax-free account or tax-deferred account so that you don't end up paying a lot of taxes on that, So that would be the example of it. But when let's say you have I'm going to lower the numbers because let's be realistic. Let's say you have 20K of qualified dividends coming in. Okay. So that's going to be, let's say you invest in some kind of stock that pays you $20,000 a year in dividend. So if this is a qualified dividend because you've held a stock for at least 60 days out of the 121-day period, and this is a U.S. company or foreign company on the New York Stock Exchange, and let's say your annual income is 100K, and you're married, filing jointly, okay? So let's say that's your taxable income. If you add this up together, you're going to have $120,000 in income. However, because this is taxed as long-term capital gains tax, I'm going to move it down a little bit. You're taxed at either 0, 15, or 20%. And because if you're filing your taxes jointly, let's say you're married and you're doing your taxes together, that 100,000 plus 20,000, this one falls in the 0% category. Fact check me, because I know I'm right. But you could eventually just not pay any tax on the dividend, qualified dividend, because you're under the 0% capital gains tax threshold. So if you're married filing taxes jointly, your threshold is going to be much higher. Remember, when you look at the capital gains tax brackets, it's going to show $94,000, but you need to add the standard deduction to it because $94,000 is the taxable income. And so you add $94,000 to the $29,200 for the standard deduction, and that's going to give you about $123,000 or $124,000. So this $20,000 could eventually become a tax-free dividend income, either going into your checking account or just reinvest into it. So nerded out a little bit, but yeah, appreciate you asking. Let's see. Got 5 minutes, so let me take a look. Let's see. Yeah, you're right, Pavel. Nice to have you here. Yeah, it's really true. A lot of people just ask me like, what's going on with the market? Which one should I invest the best? But I'm like, okay, how much money you got to invest in it? It's like $1,000. I was like, you're gonna have to, so what are you gonna do with the $1,000, right? Start investing. Obviously, it's a good thing to start investing, but you need to have a plan. If you got debt, you got credit card debt, and you're trying to invest, that's not gonna happen, right? you need to pay down your debt. Your credit card debt's like 25% interest rate. Well, the market's doing 10%. I mean, that's just simple math. 25%, negative 25% versus positive 10%. You're still losing money in interest to the credit card. So make sure you focus on paying down your debt before moving on to investing. Okay, so that's a good question. I'm going to go through this real quick right before their meeting. You're making $55,000 a year. You have $20,000 in brokerage and $10,000 in Roth IRA. You want to buy a house. Should I slow down my investments or just save for both? So the first thing that I would ask you is what your total financial situation is going, right? So you can go to firestatechat.com/consultation if you want to book a session with me. But it really depends on where you are. First question is I would ask you, well, do you have any debt that you're carrying? No? Okay, cool. And then the next question would be, so you're making $55,000 a year. Does your 401k come with a match? If it does, then I would put at least a 401k match to it. Now, the other thing I would recommend, and I'm just going to write this down. So debt paid off. Okay. And then the next question would be 401k match. So I would do that definitely at least a match. And did you max out your Roth IRA? Okay. So that alone should put you around 15% savings rate. I would highly recommend that you maintain that 15% savings rate at the same time you invest or you save for a home. So it also depends on how much that house is going to cost, right? What is the price range for the home? And then what is the down payment? Is this your first time home buying, right? So down payment. So it could have either 3%, right? Or do you want to do 20%? I know that's a large range, but that's something that you can kind of look into it and see what you can do. If you're in a high cost of living, or you're in California. So I don't know where in California you're in, but California housing is really, really, that's much higher than anywhere else, in my opinion. So that's something that you want to consider, but you should only buy what you can afford, right? So if you're making $55,000 a year, I don't know if you're married or anything like that, but each month you make $4,583. So let's say $4,500 a month, and you do the 25% rule. Your mortgage payment should not exceed $1,125. Now, if you get married and say you got joint income coming in, you got $1,000 a month, then your 25% rule is always going to be, could be adjustable. So it depends on the income, right? So 25% rule and income times 25% mortgage payment. If you have to go to 30%, just know that you have to make sure that you do not exceed more than 30%, knowing that you're going to get a pay increase. If you don't think you're going to get a pay increase, do not exceed 25%. You do not become house poor. House poor is a real thing in this country. People would rather buy a very expensive house that they cannot afford. Now they have no room in their budget to pay off their debt, pay off their or invest in their retirement. So those are the things that I would go over. Really good question, Christopher. There's something that I would strongly encourage you to take a look at is how much can I afford now, right? So am I going to, am I going to get a pay increase in the future? Are you going to get married pretty soon? Maybe that's something that you want to wait. That's something else that I don't recommend is buying a house with someone you're not married to. It does become a very, very sticky situation. So, but I know we got a Fed meeting coming up, but I'm going to pull up their stuff here. Going to have him muted for right now. Oh, nope, he's here.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Here we go.
Gina.
We're going to be asking, what are you doing in September?
Gina Smilek from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Well, NASDAQ is up almost 3%. That's crazy. S&P 500 at 1.7%.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Yeah. So I'm gonna, he's just not gonna say much. He's just gonna be like, I'm not gonna talk about the September meeting, and then I don't know what's gonna happen. That's more for the next meeting and stuff like that. Blah blah blah. So I think it's just gonna be a waste of time for me to go through the Q&A. Not Q&A. The Q&A between Jerome Powell and the press. What I do want to go over is to answer some of your questions, because I really appreciate all of you guys being here to tune in. And one question I had was, I'll answer a couple more questions here. Okay, for allocation, would you recommend target date retirement funds like Vanguard's low-cost target date funds in 401k and Roth IRA, and then have VTSAX and brokerage? Okay, so yeah, when you look at, I went through this, let's say, struggle of how much do I need to put into the target date retirement fund to begin with. You have pretty much 2 separate goals here. You have 401k and Roth IRA for when you're retired at 60, or earliest is 55. For the rule of 55, you can start taking money out of your 401k if you retired, or let's say you quit your job or you get fired. Doesn't matter. When you're in the same year that you turn 55 years old, you can actually start taking money out of your 401k and see how that target date retirement fund has performed in the past. And same thing with the Roth IRA. Maybe putting it into the same fund would just kind of give you the same performance, right? So the question I would ask you is how risk averse or maybe risk tolerant you are into investing for your retirement. And it also depends on your age too. If you're in your 20s, 30s, you definitely don't want to miss out on the opportunity growth, especially when you're still young and you have time to recover any losses, right? So if you start investing, let's say 2003, and at the end of the dot-com bubble, and then 2004, 2005, and then when you go through the bear market years in 2008, 2009, you still would have recovered relatively pretty good from all the way from 2007, 2008 to now and in 2024. So, and putting the VTSAX and brokerage. So if you don't know what that is, VTSAX, VTSAX, that's the Vanguard Total Stock Market Index Fund. And that gives you like the total market of like 4,000 stocks in that one single index fund. But it does perform pretty much the same as, the same as the S&P 500 index fund. They are pretty similar. So this is the Vanguard Target Retirement 2050. So when you look at this, some of the things that I would want to know is go to the portfolio composition, okay? And I'm not giving you any personalized financial advice, but I'm just giving you what you need to know to do some research of your own. So the Vanguard Target Retirement 2050 fund, this has 54% in the index fund for, so that's all US stocks. And then you have the international stocks. So that's about, 35%. Oh, shouldn't have clicked on it. And then let's see, you have bonds for about 6.7%. And then you have another bond, that would be the international bond for 3%. So you're looking at 9.7, we'll just call that 10% bonds and 90% stocks just in this target date retirement fund. So when you put 90% stocks, so 90% of your 401k is going to perform I should say 54% of that will perform like how the US stocks are doing. And that's all in the S&P 500. And then the other 35% would do what the international stocks do. So let me take a look. International right now index fund, it's about 7.2%. So you got to keep that in mind. When you're looking at this, you're going to be performing about half of that would be at almost 15% return at the time I'm recording this video. And then the other 35% will be performing about 7.2%. So you're not going to get the maximum return if you put it in the target date retirement fund. I personally don't do it because it is too risk averse for me, right? But it might be right for you because you're more risk averse than me. Maybe. So that's something to keep in mind. So 2050 for the target date fund, it's performing 9.66% return. So that is still really, really good, right? That's based on the 90% stocks and 10% bonds. So do you want the same thing in your 401k for 90 stocks and 10% bonds? And then you just have 401k and Roth IRA perform the same. And then you just invest in, let's say, VTSAX that's giving you a pretty good return too. So it's really up to you. Let me take a look. VTSAX, how's that going? And you're gonna need at least $3,000 to begin with. And this one, performance, yeah, it made a 26% return last year, and then I think year to date is 13.5%. So it's still pretty good. This is based on June 30th. So it's about a month ago. It's probably around 14.5% so far. So if you invest in something like VTSAX, this means that your taxable brokerage account is 100% stocks, all 100%. Okay. So when you click on portfolio composition, it's going to tell you how many stocks there are. So if you look at it, it has 3,674 stocks. And the median market cap, that means like the median of the market cap for each stock is about $181 billion. The other thing I want to look at is the, oh no, what happened here? The distribution. Let me refresh that. Something happened to the, there should be a top 10 holding here so that you kind of have a better idea of where it is. So this kind of gives you a better idea of how this is diversified, how for each sector, energy, financial, and 35% of it is in tech. So, if tech gets a big hit, then 35% of this index fund could take a hit as well, or it does well. It could go the opposite way. And here's the top 10 holdings. You got Microsoft, which is down a lot after yesterday. When I say a lot, probably not that much, but they didn't have a really good earnings, and that's the number one holding in VTSAX. You got Apple, Nvidia, Amazon, Meta, Alphabet, that would be Google, Eli Lilly, Broadcom, and Berkshire Hathaway. So just keep that in mind that when these 10 stocks make some moves, and then obviously you're going to see like all 3,000, 4,000 stocks in there. Maybe you look at the top 25. So if one of the companies does bad, this whole index fund is not going to be like, oh, it's all going to collapse. But you should be aware, if Microsoft does bad, then naturally, the other companies could be doing just as bad too for that one day. Okay. But look at the overall performances for the last 5 years, last 10 years. What is your target for the next, say 20 years? Are you trying to buy VTSAX so that you can retire early? Are you trying to buy a home in the next 10 years? Those are the things that you want to consider too, because, VTSAX might not be the only thing that you want to get based on the risk tolerance that you have. You may be someone like, I want to make I want to be riskier by putting in the, let's say, sector ETF. That is more like sector specific ETF or index fund or something like that. Take a look at those. Vanguard has some really good index funds. Personally, I still invest in Vanguard index funds, and they're really cheap too. And they have a really good track record of their performances. Fees are really low. So I'm a big fan of Vanguard index funds, just not a big fan of Vanguard customer service, in my personal opinion. So, but really good question. Just take a look at it, and hopefully that kind of answers your question without knowing your entire life situation. So, okay, let's see. Okay, I'll answer one more. I'm thinking about buying a Tesla, and I have the cash to pay for it. Well, Tesla's the stock is moving up today, but I'm trying to debate if I should go with their 1.99% loan. They have a 1.99% loan. Okay, cool. And let the cash grow in 5% APY. What would you do? So you have the cash to pay for it, but you want to take out a loan for 1.99% and put it in a high yield savings account for 5%. Okay, so I'm kind of curious though. Sorry, I didn't know that the Tesla had that. Tesla.com. I don't see it. Oh, it's a Model Y. Okay, so you want to buy a Model Y for? I'm guessing that's the only offering for 1.99%. That's cool. I mean, that's really low. But if you have the cash to pay for it, honestly, I would just use the cash to pay for it because I am not a fan of a car loan, and I have a Tesla Model 3 that I've been driving since 2018. That thing has depreciated so much. It's unbelievable. And it's in a very good shape too. It's down, I think it's only worth 40% of the original. No, it's probably less than that. No, it's 40% of what I bought originally. So I would pay for it in cash if that's something that you really want to do. But I mean, think about it this way, okay? If let's do some math. So if you, I don't know, how much was the Model Y? Let's put $25,000, okay? It's probably more than that. But let's say you get a 3%, let's say 3% APR for 60 months, right? I know I said 1.99, but we'll just go with 3% just so that everybody can kind of relate because not everybody wants to buy a Tesla for 60 months. So that's going to be like a car payment of $440, $450 a month, okay? So for over the course of, let's say you can take out 5 years, 3% APR, $25,000. So the total interest that you're going to end up taking out is like about $2,000 in 5 years. Okay, so total interest for the car payments, right? So if you look at the high yield savings account calculator, and if you type in, I'm going to make another box here. Let me see if I can car loan. Okay, I do this a lot, so I'll try to slow it down for you. So let's say you have your high yield savings account for $25,000. And it's giving you 4.6% APY. Let's go with that. And let's say you don't make any additional contributions. Okay, so you just want to leave it the way it is, and you want the interest to beat the car loan interest because it's 4.6% versus 3%. So over the course of the years, if you look at it, 25,000, 4.6%. So in 60 months, so per year, it's going to be about 63. Let me do the math on this. 6303. So 6,300 divided by 5. You can welcome to fact check me on this. So you're going to be making about $1,250-ish a year in interest. So that's going to be a total of $6,303. No, $6,300 in 5 years. Total interest in 5 years. Okay. And let me know if I'm going too fast. But so you have a 1950 here. Okay, so that's an eraser. So right here, $1,950 in car loan that you're going to be paying, and you have $6,300 that you get from total interest from the high yield savings account. Okay, so let's do some realistic math here. All right. So what if you did, okay, let's do 6,300 minus, let's say 2,000. Let's just round it up. So you make $4,300 in total interest in 5 years. Okay, so if I divide that by 5 years, that's $860 a year in interest that you save for taking out a loan and leaving your money, $25,000 in a high yield savings account. So you're gonna save $860 a year. Huh. Okay, so how much is that per month? $72 a month. Is it really worth the hassle to do that? I mean, if you think about it this way, car payment, from my experience working with my clients, and you can schedule a session with me by visiting firesession.com/consultation, but car payment a lot of times just end up becoming an expense instead of making more on interest, right? So how many people actually just leave their $25,000 into the high yield savings account? You may tell me that in the comment section, okay? Maybe, but most people don't. And they end up treating that $450 a month right here into an expense as a part of it, right? So I like Tesla, and I've been driving it for 6 years, going on 7 years, but it does depreciate fast. So your $25,000 could be worth $6,300 to $13,000 in 5 years. So, I mean, it's just, I don't like car loan as much as I don't like credit card debt. I probably hate the credit card debt the worst. Credit cards are very rewarding if you know how to use them correctly, but you have to ask yourself, okay, is it really worth paying $450 a month on a car payment so that you could have a net savings of $72 a month? Let me know if I'm wrong in the comment section. If I did the math wrong at all. Am I wrong on this? I mean, you're making $6,300 total in interest in 5 years. And this is also variable too. We don't know if it's going to be 4.6% APY. Everybody's talking about the rate cuts coming in September. Depending on when you're watching this, it could very well be down to 4.25%, maybe 4%. So this is not going to be 6,300, maybe 5,500. Now you're not going to be making as much on the return, right? Return on the high yield savings account. So now this could be a lot less, but you got to remember this. This is in 5 years that you earn $4,300. So $860 a year or $72 a month, or do I want to pay that whole thing off and just pay it in cash? And I believe you still get that $7,500 tax credit too, right? Yep, by the end of this year. So no, I would just pay it in cash. Tesla depreciates fast. It's a great brand, great car, but make a good financial decision. Be financially free from the car loan. Don't take it out. Just pay it with cash and move on. Okay. Great question. I'm not trying to, beat you down or anything, but it is something that a lot of people argue with me and say, well, this is a 0% interest free. Okay. Tell me how much you really saved from that interest-free loan or credit card that you took out, right? You're not really saving much when you look at a small number. Mortgage is a one thing. That is a completely separate subject. So if you're taking out like a mortgage for $300,000, $400,000, and then you ask me if I want to pay it off in cash today, and I would probably say no, because I am so far away from retirement, but I could earn a lot more in the market if I had $300,000 saved or invested, right? That's a different story, but we're talking about $25,000, maybe $30,000 for the Model Y. I mean, the Model Y looked pretty good. Okay, so it's like $40,000. Man, it looks clean. It looks nice. I would go with the cash option here, and $31,000. That's really good. I would pay for it in cash. Not a Tesla sales rep whatsoever, but just be financially free and don't you got the cash for it, pay for it. Just use cash. All right. Great question. Thank you. All right. Jerome Powell is still talking probably about how they don't know yet if they're going to cut rates yet, but we all know that it's probably going to happen. But anyway, I really appreciate you guys being here. Another live stream coming up next Wednesday about the financial independence movement and how to really get started. That's going to be the next subject. But I appreciate every one of you being here. And if you're here on a replay, I will make sure to leave the timestamps on there. So anyway, until next time.